Brad Williams, Frugal Finance. There are investment products of every means. Wall Street is always creating something in order to spice up the appeal. This information from CFTC might be a little bit dated, but it's relevant. Learn about risk before investing in commodity ETPs or funds. Question here is, what is an ETP? Recent market volatility due to, so many different variables. They're using COVID here, but we can say political or economic or COVID or what have you. But this particular volatility has prompted many investors to purchase shares of trading vehicles that use futures contracts or other commodity interests, either in hopes of profiting from a recovery in a particular commodity price or as a means of diversifying their portfolios. These trading vehicles may be organized as exchange-traded products or mutual funds, but that does not necessarily mean they will behave like traditional exchange-traded funds or mutual funds that invest in stocks, bonds, or other asset classes. For example, these vehicles might not provide investors opportunities to buy the dip or profit from long-term price gains in the underlying commodity. Fundamentally different than securities. Commodity ETPs and mutual funds invest in futures, options, swaps, or foreign exchange, and often are commodity pools whose operators are regulated by the CFTC. Commodity future markets present different risks than securities markets. For example, when individual investors or mutual funds buy shares in a company, they own a portion of that company. These shares are assets and can be owned indefinitely. Commodity pools, including commodity ETPs, on the other hand, purchase time-limited contracts that convey the right to buy or sell an asset, called the underlying asset, at some point in the future. Contracts do not convey ownership in the asset itself. The value of the shares in the commodity pool may not track the value of the underlying asset over time. This difference is because, unlike with stocks, a futures contract cannot be held indefinitely in hopes that a fallen price will recover. Future contracts expire, and contract holders must either deliver or take delivery of the underlying asset or close out their contract by taking an offsetting position before the delivery date. For example, to offset 10 long contracts to buy June liquid natural gas, you would need to short 10 contracts to sell June liquid natural gas. Know the risks. For energy commodities and associated future contracts, risks are often related to supply and storage availability. For ag commodities and associated future contracts such as corn, soybeans, or wheat, the risks are often weather-related. Meanwhile, metals such as gold, copper, and palladium and the future contracts are affected generally by industrial and macro factors. Whether the pool you plan to invest in focuses on a single commodity or a broad mix of commodities, you should research the risks associated with the commodities and the industries that utilize them. You should know what conditions can influence their prices and activity, and actively monitor those conditions while you participate in the fund. In addition, there is risk that the pool's holdings or strategies could shift to compensate for changes in market conditions. The pool's disclosure requirements will disclose its objectives, trading strategies, principal risk, and flexibility to make changes. Read these disclosures thoroughly and watch for updates, notices, or supplement on the fund's website. Commodity pool disclosure documents also must include information about the following: management and firm principles, the name of the pool operator, pool managers, and commodity trading advisors, as well as ownership information and registration status. Fees and expenses, management fees, advisory fees, brokerage fees, and commissions and interest paid. They're generally very high. Be careful here. You might be stepping into a mousetrap and in the end find that their fees and expenses are outrageous. Break-even analysis, a table showing the amount the pool must earn after 1 year in dollar and percentage terms to recover the amount of your initial investment plus fees and expenses. Performance, pool has to accurately report its past performance. Redemption information, how to redeem shares in the pool, including any restrictions that may exist. The impact of rolls on annual returns. Finally, Rising commodity prices may actually create a drag on commodity pool annual returns. The only way for a pool to maintain an ongoing position in a particular commodity future contract would be to conduct a roll, closing out the expiring contract, also called the near or front month contract, and entering another contract with a later delivery date called out month contracts. If the prices for out month contracts are increasing, then the pool may lose money each time front month contracts are rolled. Small increases in price, month over month, could be a sizable drag on annual returns when added to applicable trading and management fees. By contrast, when out-month contract prices decrease, it could have the opposite effect and result in a roll yield. A couple things you might want to consider for investing in an ETP. Assess carefully any representation that by trading commodity interest, a pool should outperform stock and bond funds during recessions or in other financial downturns. A pool's actual performance may indicate otherwise. As you review the prospectus or disclosure documents for a commodity ETP fund, consider what financial instruments will the commodity pool be allowed to trade? How do these instruments behave when markets go up or down? What could happen to those financial instruments in extreme market conditions? What changes to the announced trading strategy is the commodity pool operator permitted to make, and under what circumstances? Can changes be made without notifying participants? If you don't understand the language I just discussed, perhaps this is not the type of investment for you. Otherwise, if you're familiar with ETPs, comment. Let me know if you've had success or failure. I've had a few, and they are a farce. I've lost a lot of money in these things because the dance these operators do. In other words, they just throw a lot of legalese in the prospectus, and they can modify it at any point in time. Subsequently, you're generally the victim. So that's my 2 cents worth. Give me your 2 cents. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.